What comes to mind when you hear the name Warren Buffett? The Oracle of Omaha? The greatest investor of all time? That friendly grandpa who drinks cherry Coke and hits up McDonald's? You're not wrong, but the real story of how Buffett built one of the biggest fortunes on the planet goes way deeper than just buy low, sell high. We all know the headlines, but the true engine of his success is a set of simple, timeless principles. Principles that are often ignored because they require something harder than intellect, discipline and temperament. Today, we're not just pulling back the curtain, we're diving deep into the 5 core lessons that built Berkshire Hathaway. We'll unpack the mindset, the specific strategies, and the historical moments where these lessons turned into billions. This is the real-world playbook, straight from Omaha. And the first lesson is the foundation of everything else. Picture the financial markets. It's all yelling traders, blinking screens, buys and sells every nanosecond, right? The entire industry is built on the idea that you must be constantly doing something. Now imagine a guy who built his wealth by doing the exact opposite. Buffett is the king of what he calls masterful inactivity. His famous line is, "The stock market is a device for transferring money from the active to the patient." But this isn't just a cute quote, it's his entire operational model. While everyone else is scrambling to make a move, reacting to every headline and tick, he's reading. And I mean, he's reading. He estimates about 80% of his day is just reading annual reports, newspapers, and industry analyses. He builds a deep reservoir of knowledge so that when opportunity strikes, he's prepared. Think about his physical environment. He works in Omaha, Nebraska, far from the Wall Street frenzy. His desk isn't surrounded by monitors flashing real-time quotes. This is by design. He creates a space where he can think, not just react. He's totally fine going months, even years, without making a major move. He often says his favorite holding period is forever, but a close second is as long as possible. He waits for that fat pitch. He uses a baseball analogy from the legendary hitter Ted Williams. Williams only swung at pitches in his happy zone, where he batted 400. He let everything else go by. Buffett doesn't swing at every ball that comes across the plate. He waits for the one that's right in his wheelhouse, where the odds are overwhelmingly in his favor. This requires an immense amount of cash on the sidelines, which is why Berkshire always maintains a huge war chest. He's not waiting for any opportunity, he's waiting for his opportunity. So think about your own money. How many of your moves have been knee-jerk reactions, FOMO buys, selling in a panic because the market had a bad week? Buffett's first lesson is a call to just chill, to build your knowledge base, and to understand that inactivity is not laziness, it's a strategic choice. In a world screaming for action, the real power often lies in disciplined inaction. Here's the fundamental mindset shift that's worth millions. For most people, stocks are just symbols that bounce around on a screen. It's an abstract game. For Buffett, every single share is a piece of a real, living, breathing business. This is the core of what's called value investing, taught by his mentor, Benjamin Graham. But Buffett took it further. He doesn't ask, is this stock going to pop next week? He asks, if this stock exchange shut down for 10 years, would I still be happy owning this business? He analyzes the business like he's going to buy the whole thing. This involves digging into the financial statements, but also understanding the qualitative aspects. He needs to know, is management straight shooting and capable? Are they good capital allocators, or are they empire builders wasting shareholder money? Crucially, does the company have a killer competitive edge, what he calls a wide and durable moat? A moat can be a powerful brand like Coca-Cola, a regulatory advantage, high customer switching costs like Apple's ecosystem, or a low-cost production model like Geico. He bought See's Candies back in '72 for $25 million. It wasn't a tech darling, it was a box of chocolates. But people loved it. The brand was iconic on the West Coast. It had pricing power. They could raise prices and people would still buy. Decades later, See's has generated over $2 billion in pre-tax earnings for Berkshire. He didn't buy a volatile stock symbol, he bought a simple, profitable, beloved American brand. This changes the entire evaluation process. Instead of staring at price charts, you're analyzing financial health, brand strength, and management quality. When you put your money in, you're not betting on a ticker. You're becoming a part owner in a company. Think like a business owner, not a stock trader. It changes the whole game, from your research to your holding period. Simple concepts is the circle of competence. Draw an imaginary circle around the things you truly, deeply understand. Inside that circle, you can make informed decisions. Outside of it, you're just guessing. Buffett is brutally honest about his circle. Back in 1999, the whole world was losing its mind over tech stocks. The dot-com bubble was inflating. Everyone and their brother was getting rich overnight on companies with no earnings. And Buffett? He sat it out. Critics called him a dinosaur, a relic, said he didn't get the new economy. And his response was pure genius. You're absolutely right. I don't. He admitted it was outside his circle. He understood brick-and-mortar businesses, insurance, Geico, banking, Wells Fargo, consumer goods like Coca-Cola and Gillette, and railroads like Burlington Northern. He could analyze their cash flows and moats. He couldn't predict which internet startup would win, so he didn't play. When the bubble burst in 2000 to 2002 and paper fortunes vanished, Berkshire's value held steady. He didn't lose a cent on that mania. But here's the key. A circle of competence isn't static. You can expand it slowly and deliberately through study. Years later, he came to understand Apple not as a chaotic tech hardware company, but as a consumer products company with a ferociously loyal customer base and a powerful ecosystem, a moat, that fit within his expanded circle. So what's your lane? What industry, business model, or type of company do you understand better than the average person because of your job, your hobbies, or your studies? Maybe your biggest financial break isn't in some hot, complex tech stock, but right there in your own backyard, in a business you can see and understand plainly. The goal isn't to have a huge circle. It's to know its exact boundaries and have the discipline to stay inside them. This is his most famous line, but almost nobody has the guts to follow it when it counts. Be fearful when others are greedy, and be greedy when others are fearful. This isn't about market timing, it's about a fundamental shift in perspective. Buffett looks at extreme market pessimism as a sale on wonderful businesses. He needs two things for this to work: cash and courage. He always keeps cash ready for when the world panics. Let's look at history. During the 2008 financial crisis, total panic, markets in free fall, Lehman Brothers collapsed, sheer terror. Headlines screamed about a second Great Depression. And Buffett? He went on a historic shopping spree. He invested $5 billion in Goldman Sachs and $3 billion in General Electric during the peak of the crisis, getting favorable terms with high dividend yields. Later, he bailed out Bank of America with a $5 billion investment. He wrote an op-ed in the New York Times literally titled, "Buy American, I Am." He saw what the hysterical crowd missed, a panic-driven fire sale on world-class businesses with temporary problems. While everyone was rushing for the exits, he was backing up the truck. Years later, those crisis-era bets generated tens of billions in profits. But go back further. In 1973-74, during a brutal bear market and stagflation, he was buying Washington Post stock aggressively. He was buying while others were utterly despondent. This lesson is the ultimate test of temperament. An investor's worst enemy isn't the market, it's their own gut reaction, their mirror neurons firing, telling them to follow the herd. It feels safe, but it's financially dangerous. Mastering your emotions, having a clear criteria for what makes a good business, and acting when those criteria are met at a discount, that's the hardest and most profitable skill of all. You have to be optimistic about America's long-term future and pessimistic enough about human nature to know that crises will regularly create these opportunities. Why is Buffett so much wealthier than other investing legends who were also brilliant? The answer isn't just a higher IQ, it's the unmatched combination of a high rate of return and an extraordinarily long time horizon. He started his first business at 6, filed his first tax return at 13, and bought his first stock at 11. He's been compounding capital for over 75 years. The math is staggering. Over 99% of his net worth was made after his 50th birthday, and over 90% after he hit 65. That's the raw, explosive power of compound interest. Albert Einstein supposedly called it the eighth wonder of the world. It's the financial snowball rolling down a very long hill. Your money earns a return, that larger sum earns a return, and on and on. The gains seem small at first, but eventually the curve goes almost vertical. Look at his partnership with Charlie Munger. They didn't seek flashy, quick doubles. They sought consistent, above-average returns, say 20% annually, year after year after year. A 20% annual return turns $1 into $38 in 20 years. In 50 years, it turns $1 into over $9,000. That's the math Buffett exploited. He found wonderful businesses that generated huge amounts of free cash flow. He then used that cash flow to buy more wonderful businesses, accelerating the snowball. He didn't get rich quick. He got rich slow, steady, and inevitably. He calls this getting rich without getting scared. This lesson is the most liberating and the most demanding. It's liberating because you don't need a Wall Street bonus or a lottery ticket to build real wealth. You need time, consistency, and patience. It's demanding because it requires you to start early, to live below your means to fund your investments, and to leave that money completely alone to do its work. Starting early, even with just a little, and letting it compound in a low-cost index fund or a few wonderful individuals over your entire life is the ultimate case study in compounding, not just of money, but of knowledge and relationships. So, let's tie it all together. Patience to wait for your pitch, the mindset of a business owner, not a stock speculator, the humility to operate only within your circle of competence, the contrarian courage to buy when there's blood in the streets, and finally, the faith in time and compounding to do the heavy lifting. Warren Buffett's playbook isn't a collection of complex algorithms or hot stock tips. It's a philosophy, a framework for thinking about money, business, and risk. It's about wisdom, rationality, and emotional control, not about being the smartest person in the room. The real secret to his success isn't locked in a spreadsheet in Omaha. It's a replicable mindset. The good news? This philosophy is accessible to anyone. You can start applying it today. Read more, speculate less, think long-term. Know what you own and why you own it, and most importantly, start. Start building your snowball on a path that's long and sloping. The final question isn't which lesson is the most important. They all work together as a system. The real question is, do you have the discipline to embrace this boring, brilliant, and profoundly successful way of building wealth? Your story is still being written. What will your next chapter be?